Though unique, trading practices in the world of cryptocurrencies are influenced by a lot of things outside it. People even draw inspiration from the outside. And even if cryptocurrencies were first made to break free from the shackles of the world and the supposed elites and government entities that control it, major world events still affect the world of cryptocurrencies. But that's not everything. Little things seep into the cracks of the wall that separates the world from the whole cryptoverse. And although these might sometimes be leveraged by criminals to extend their evil deeds into the digital world, most things that manage to cross that wall become the foundation of innovations. Welcome to our channel, where we show you all the latest, relevant, and any information that has to do or affects the world of cryptocurrencies, all in the comfort of your very own Crypto Addict. Today, we'll show you one of the most innovative crypto trading practices that crypto traders and enthusiasts have slowly been getting into, and that is short selling or shorting. Before anything else, please remember that this video is not any form of financial advice, but solely our fact-based opinion that is meant to educate and inform you of the latest and most relevant information fresh from the world of cryptocurrencies. We strongly urge you to do your own research before dealing, trading, or buying any cryptocurrencies. Knowledge is your greatest asset. Invest in it first. Let's get to it. For the highly volatile crypto market, crypto traders and enthusiasts looked for ways to try and gain money even if the crypto market is facing some setbacks like the current crypto winter we are experiencing today. In their quest to find the ultimate solution to lowering crypto coin prices, they utilized and incorporated a very ancient trading practice called short sell or shorting. So, what is shorting? In a more broader sense, it is an investment practice where an investor roots for a stock to depreciate in value rather than the usual investing target of stock prices to go up. For some, it is considered to be a high-risk and advanced investment method. Others consider it to be a dubious scheme designed to pull people and the market under. So why is it even called short selling in the first place? For the simple reason that investors who venture using this method are short or lacking. They don't actually possess the asset they intend to sell in order to generate money. And though it is used in the cryptoverse nowadays, it isn't exclusive to it alone. The trading or investment practice is as old as trading itself. And like anything else that is historic, especially things that involve money, short selling wasn't spared by dubious characters in the trading world. There were multiple times in the past where short selling was banned in countries such as the USA and the United Kingdom, and investors involved in shorting stocks were blamed for all sorts of bankruptcies and crashes, like that of the 1929 stock market crash. But short selling outgrew all that and has now become a legit trading strategy for investors to develop and use. This strategy's fundamental process is borrowing an asset beforehand, then selling it at market price. You eventually buy those assets back from the lender from whom you borrowed them. The value of these assets decrease as it is anticipated when you have to buy them back. Therefore, technically, you will have paid less for the assets than you did for them when you bought them. And in doing so, traders and investors are able to benefit from an asset that they have yet to purchase. Here's an example for you to visualize and understand it better, and we will be using the current #1 cryptocurrency, Bitcoin, for this example. Let's say that you have available funds to invest, but there's an ongoing crypto winter that almost assures the lowering of value of every coin on the market. You can still take advantage of this current market state by shorting or short selling. In order for you to gain even on a declining market, you can borrow 5 Bitcoins for, let's say, $500 per Bitcoin, and short sell them for $2,500. You will then be lacking 4 Bitcoins. After a certain amount of time passes, the actual market price of Bitcoin lowers to $400, an ideal scenario for you and other short sellers. This is then your chance to buy the Bitcoin you were lacking when you started to short Bitcoin. Your 5 Bitcoin short will then only amount to $2,000, which you then return to the lender or broker who lent you the 5 Bitcoins. Because you bought the Bitcoins you owed and paid your broker with for a lower price than what he lent you at the start of your transaction, you will then have $100 worth of profit per Bitcoin. That's $500. For short selling 5 Bitcoins in our example. Let's go over again and summarize it. You initially borrowed 5 Bitcoins from a broker and sold it for $2,500. After the price of Bitcoin dropped to $400 per coin, you initiated to buy them back and pay your broker the initial 5 coins you borrowed. That gives you an earning of $100 per coin and a total of $500 for the 5 Bitcoins you shorted. But the scenario we used is an example only where the market value of Bitcoin dropped to your favor. That also means that the more the market drops after you short sold your Bitcoin, the more advantageous it is for your investment, as it will be cheaper for you to become. But it's not all sunshine and roses for short sellers. As shorting is not a conventional way to trade, there's significantly more risk for investors. Market volatility, positive ticks on the market, or specific cryptos that you short sold, and your broker asking for payment before your target value are some of the few factors that could significantly increase your losses. We all know, however, that risks don't really do much for the trade-hungry investors, and maybe you're thinking of shorting crypto right as soon as you can. Or maybe you're wondering if you're even allowed to short crypto. Well, we're glad to tell you that you are allowed to short crypto. We already showed you an example of how to short Bitcoin earlier, and that's basically all you need to do to short sell any crypto. But unlike mining, buying, and other conventional ways of trading crypto, short selling requires more than investors in terms of market analyzing and prediction, and not to mention the massive amount of capital you need in order to even start shorting crypto. Like other trading strategies and practices, there are also multiple ways to short sell cryptocurrencies. Finding a trading platform that enables short sell orders is the first step. Even better, look for a platform that uses bots to execute orders for you. Then there are numerous strategies to short sell cryptocurrency. Margin trading. Perhaps the easiest and most convenient way to short sell crypto is by using margin accounts, as this is likely the simplest method for shorting cryptocurrency. Margin trading is the practice of borrowing cryptocurrency from a broker in order to place a deal. You will need to borrow money or use leverage while trading in this manner. This, however, is designed for traders who have a lot of experience investing in the highly volatile crypto market. If you're one of these experienced traders, or if you have done your research and are pretty confident with your strategy, then you could take it even a step higher by using automated trading platforms for your transactions. This will allow you to eliminate a significant amount of errors or mistakes you might commit during one of your transactions. In short selling being a highly risky trading strategy, you'll need every bit of help you could get your hands on. Though there's currently no automated platform that deals specifically with short selling, given the growth of the industry, we're confident that we could be seeing some kind of automated trading platform variant in the near future. CFD. Contact for difference is referred to as CFD. This indicates that you have decided to simply accept the difference in price rather than really borrowing cryptocurrency, selling it, and then buying them back at a cheaper price. So, if the price declines, a CFD will pay you the difference, even without the inconvenience of exchanging and repurchasing coins. Using the utilities of organizations like eToro, Plus500, and others, anyone can short with a CFD. However, you should be informed that experienced traders should only engage in this type of trading because it carries significant consequences. Binary options. This one is a pretty simplistic win or lose scenario where you try to predict the depreciation of a coin with a specific amount of time. If you're correct with your predictions, then you will earn money. If not, then you would incur losses. Now, knowing all these and the risk from any kind of short selling strategy, you might be thinking hard whether to pursue short selling cryptocurrencies or not. Well, we're here to tell you that even though it is not easy and there is pretty much no limit to the amount of losses you could incur, shorting crypto is still a viable way to earn money in the cryptoverse. But we must stress this one last time to you. Make sure that you have researched and gathered enough experience for you to engage in high-risk trading strategies like short selling. Oh, and after watching this video, try and ask yourself if you'd still be rooting for a coin you short sold to drop in value, knowing the majority of traders out there will lose a ton of money. Give a little explanation on your answer down the comment section to help guide others on whether they want to engage in short selling or not. That's all for today. Don't forget to like our videos and follow our channel Crypto Addict. If you don't want to miss any of our next videos, then hit on that notification button as well.